Welcome to The Explainer. Today, we are going to break down a term you've probably heard just about everywhere. From boardrooms to news headlines, ESG. It stands for environmental, social, and governance. And trust me, it's completely changing how we think about the real value of a company. Okay, so let's just dive right into this. For decades, right, we've measured a company's worth with a pretty simple financial toolkit. We looked at things like profit, revenue, the assets on its books. It was really all about the numbers you could pull from an annual report. But the world is changing, and investors are starting to realize that those traditional metrics, they only tell part of this story. They give you this snapshot of how a company did in the past, but they totally miss hidden risks and future opportunities. Things like, how is a company actually preparing for climate change? Or how is it managing its workforce? The ESG view, on the other hand, tries to look ahead and forecast a company's future resilience. And this is exactly where ESG comes in. The best way to think about it is like a powerful new lens. It's a framework that helps investors assess these really crucial factors that don't show up on a normal balance sheet, but can have a massive, massive impact on long-term success. So let's break it down, starting with the E for environmental. This is all about how a company interacts with the natural world and, the risks and opportunities that come right along with it. Now, this isn't just about planting a few trees or having a recycling bin in the office. No. It's about understanding these deep material risks to the business itself. How does a company manage its carbon footprint? What's its game plan for water scarcity? These have become multi-billion-dollar questions. And this slide, it perfectly illustrates the two main types of environmental risk. Over on the left, you've got physical risks. We're talking direct impacts from a changing planet, like a hurricane knocking out a supply chain. Then, on the right, you've got transition risks. These are the financial threats that pop up as society itself shifts away from carbon, things like new taxes or customers suddenly demanding greener products. And this timeline right here shows us exactly what that transition risk looks like in the real world. While some companies totally saw the writing on the wall, others just didn't. For instance, as the big shift to renewables got going, a company like PBD Energy, a huge giant in the coal industry, just failed to adapt. And that led directly to their bankruptcy in 2016, which completely wiped out value for investors who hadn't priced in the risk of a global move away from coal. All right, let's move on to S for social and see how this all builds together. This factor is all about relationships, how a company treats its people, its customers, and the communities where it actually does business. Essentially, it's asking a simple question. Is this company a good citizen? And that covers a huge range of stuff, from fair labor practices and data privacy to customer satisfaction and community engagement. In our hyper-connected world, a company's reputation can be its greatest asset or its biggest liability. And believe me, it matters more than ever. The data is just crystal clear. A 2020 Edelman study found that a staggering 71% of consumers are ready to ditch a brand if they think it's prioritizing profit over people. That is a massive risk to the bottom line. So here's the crucial point. Strong social performance isn't just some PR exercise. It's a core part of risk management. A bad relationship with the community can lead to protests, legal fights, even operational shutdowns, all things that directly hammer shareholder value. And finally, we get to G for governance. So if E is about the planet and S is about people, G is about the internal rulebook that keeps a company on track and, really importantly, builds trust with its investors. Think of it like the company's nervous system. Good governance is what ensures accountability, fairness, and transparency in how a company is actually run. It answers the big questions like, who's in charge here? How are they getting paid? And are they really acting in the best interests of the shareholders? Without strong pillars like an independent board and fair executive pay, a company is just so vulnerable to mismanagement and scandals. For any investor, a weak board that isn't diverse or independent enough, or a pay structure that encourages short-term gambles, well, that's a major red flag that the company could just implode without any warning. So the big question is, how do we measure all of this? It's one thing to talk about these concepts, but it's a whole other thing to turn them into hard data for investment decisions. And that's where it gets a little complicated, which leads to a really crucial concept that investors have to understand. To get the full picture, investors use a concept called double materiality, which is what you're seeing here. Just think of it like a two-way street. The first part, on the left, is financial materiality. That's how the world affects the company. For example, does a new climate regulation hurt its profits? The second part, over on the right, is impact materiality. That's how the company affects the world. Is its pollution harming a local community? A truly complete ESG analysis has to look at both. Now, because ESG is still pretty new, a whole bunch of organizations have created different frameworks to measure it, leading to what a lot of people call the alphabet soup of standards. And while groups like the Global Reporting Initiative, or GRI, and the Sustainability Accounting Standards Board, or SASB, while they're all working towards the same goal, creating a common language for reporting, the lack of one single universal standard is a major challenge for investors trying to compare companies. But with this flood of new data comes a huge risk: greenwashing. This is when a company spends way more time and money marketing itself as sustainable than it does on actually minimizing its negative impact. It's a pretty deceptive strategy that thankfully regulators and savvy investors are really starting to crack down on. So, what does all this mean for the big picture of finance? And more importantly, what does it mean for you as an investor or even just an engaged citizen? Well, what we're witnessing is a fundamental shift. Trillions of dollars in capital are increasingly flowing towards companies that demonstrate strong ESG performance. This isn't just some passing trend. It's a massive reallocation of resources that is going to shape the industries and innovations of tomorrow. Ultimately, the goal of integrating ESG is to create a financial system that not only generates returns, but also contributes positively to the world. It's about building a more resilient, more sustainable economy by recognizing that long-term value creation really depends on a healthy planet and a stable society. This whole shift empowers every single investor to think beyond just financial returns. It reframes investing as an act with real-world consequences, and it forces all of us to ask a really powerful question: if every dollar you invest is a vote for the kind of world you want to live in, what future are you voting for?